Hello, everyone, and welcome. I am Mariana Mazzucato, professor in the economics of innovation and public value at University College London, where I'm the founding director of the Institute of Innovation and Public Purpose that this evening is chairing this wonderful conversation. I will be chairing the discussion, and I really want to welcome you all. We're so delighted that you could all join us, and hopefully I won't have to keep asking if you can see me. So today's talk is about going beyond business as usual towards an inclusive and sustainable economy. And this really goes to the core of why we actually set up the Institute. The whole issue about directionality, right? That we're not just out there to pursue growth, but actually to build an economy and a type of capitalism, there's varieties of capitalism, that is more inclusive and sustainable, absolutely requires asking the questions that Roger Martin asks in this wonderful book, which I have here, When More is Not Better, Overcoming America's Obsession with Economic Efficiency. And that's because there's nothing inevitable about the system we have. And I think a lot of us realize that there's major faults in the system, but it's not about sort of fixing different problems here and there. What we advocate in IIPP is that we need actually a new framework, which is about market co-creation and co-shaping, not market fixing. And that really requires going to the heart of governance of all the different types of organizations that within the economy co-create value. That includes both public organizations, private organizations, so all the question about corporate governance, which Roger has actually been writing about for years, decades, and also their interrelationships, the systemic properties of how different organizations work together, because in the end, the outcome of that is the kind of market and the kind of economy we have. So in Roger's talk and in the session today, we'll be debating how the drive for efficient capitalism has actually created an unprecedented state of economic disparity, and look into how this affects other areas of the economy and other metrics we might have to see how sick the system is, but also the heterogeneity between different countries. So we'll be looking, for example, at some of the issues that Roger talks about, how they affect developing countries differently from developed countries, industries differently, depending what kind of industries they are, and always raising back this issue of governance, right? That there's no deterministic type of system. It is an outcome of how we actually govern organizations and their interrelationships. And we're absolutely delighted to be hosting this event with Roger and to launch his book, because in fact, Roger was one of the founding advisory board members of IIPP. And when he won his wonderful prize, which I love the title of it, World's #1 Management Thinker, this was the same year we actually set up IIPP. And I asked him, hey, if you're so smart about management, tell me what I should do with this institute. And he said something to me that I keep repeating every time we need to make a decision. I say, Roger told me when I asked them that $1 million question, he said, whatever you do, don't lose your buzz or your purpose. And it might sound simplistic, but so many of our decisions that we make in organizations reduce our purpose and our buzz. Anyway, so let me just quickly introduce our speakers, starting, of course, with Roger. And then what will happen next is Roger's going to present his book for about 15 minutes. And then I'm going to ask our discussants, who I'll again introduce to you in just a minute, to respond. We're then going to have a bit of a discussion between us. And then, of course, we'll open up for Q&A. So Roger Martin is a professor emeritus at the Rotman School of Management at the University of Toronto in Canada, where he also served as dean from 1998 to 2013. In 2017, as I mentioned, he was named the world's #1 management thinker, and he's written 12 books, including his most recent one, this wonderful yellow one, When More is Not Better, which we're discussing tonight. Dr. Keston Perry is a lecturer in economics at the University of West England in Bristol. His work examines industrial policy, climate finance, and global development issues with particular reference to resource wealthy countries in Latin America and the Caribbean. And I cannot emphasize how important it is to be looking at these issues across different types of contexts, because the idea that we have a variety of different ways to set up our economic systems can only really have granularity to it if we actually know something about these different economic systems. So Keston's work is absolutely fundamental in terms of also his regional focus. John Elkington is co-founder and chief pollinator, I love that word, sounds like you're a bumblebee, at Volans since 2008. And this is actually a company and consulting company that really focuses a lot on the issues of this book about actually how to create more sustainable business models? What does it actually mean concretely to bring purpose to the center of corporate governance, as opposed to just talking about it in the Davos kind of settings? He was a faculty member of the World Economic Forum, speaking of Davos, from 2000 to 2008. And his most recent book, which I recommend to all, is called Green Swans: The Coming Boom in Regenerative Capitalism. Again, another book which emphasizes there's differences in the ways we can actually set up our business models and our capitalist system. And that was published just last April. So if you haven't bought it, please do. Buy it, please do. So in terms of what happened next, I've already mentioned, Roger's going to speak. We're then going to talk, we're going to comment and talk between ourselves, but please note that IIPP will be live tweeting during the event. And so everyone can be following us at IIPP UCL with an underscore in the middle hashtag, Twitter address, and the hashtag is hashtag IIPP Inclusive Economy. You can send in your questions and comments using the Q&A icon at the bottom of your screen. And David Freeman, one of our PhD students, will be feeding some of those questions. Unfortunately, we usually cannot answer them all. Anyway, so without further ado, and I'm glad I actually finished way before time. I don't know why I was given all that time for an introduction. Roger, please share your screen, introduce your book to us, and you have up to 15 minutes.
Well, thank you, Mariana. It's been great to be part of your venture, and what you didn't say about you is you were a member of the MPI Fellows Group that helped immensely to contribute to the book. So I will thank you publicly for doing that. So obsession is the central word here, and I thought I'd start with the question of what obsession, where did it come from, and what problems have it caused to the operations of democratic capitalism? So this obsession, I think, can be tracked to these four gentlemen and how the world has responded to them. Top left, of course, is Adam Smith, 1776, Wealth of Nations. He got us off on an obsession, on an efficiency track with his pin factory, right? Explaining to the world that if one person made entire pins, they would be less efficient than if you divided labor, created a division of labor. So one person made stems, one person made heads, and another person put them together. You'd have a greater output of pins. So that ended up being very influential in the world. It was very influential to the founding fathers in the US economy, who had his book. It was in all the libraries, and they were influenced by that. 41 years later, the gentleman on the upper left, David Ricardo, explained to the world that you could be even more efficient if you traded. If you specialized in what was your comparative advantage. So famously, Portuguese farmers should grow grapes, make wine because they have abundant sun. British farmers should raise sheep because they don't have sun, and make wool. And the two countries should trade, and they would be more efficient than if those poor British farmers tried to make wine and the Portuguese farmers grew sheep as well. They wouldn't be as efficient. So those were two pushes to greater efficiency. Then bottom left is Frederick Winslow Taylor in the management domain, who established scientific management and showed how if you would use stopwatch time and motion studies, you could figure out exactly how efficient to be, how big a shovel somebody shoveling coal should use to have the optimal amount of coal that would be efficient but not tire them out too much. Again, being more scientific and pushing the bounds of efficiency in that way. And then W. Edwards Deming in the bottom right-hand corner, the great American quality guru, who showed how with total quality processes, you could get rid of waste and have more efficient and effective processes. Now, these are all good things, right? So pursuing efficiency is a good thing, but only up to a point. And pushing it past a certain point, and especially a point that at least three of these four gentlemen, I'm not sure if there was a point of efficiency that was too great for Frederick Winslow Taylor, but at least the other three, starts to create a problem. Now, what was the assumption behind pursuing efficiency, ever greater efficiency in a capitalist economy? The assumption was that we would produce an outcome that looked kind of like this, right? Which is, and famously in developed economies, they always feature a large middle class of middle incomes, plus a smaller tail of rich folks and a smaller tail of poor folks. And the idea behind this is also that you tax the rich more than the average, so that you can fund programs that help the poor, help mobility, help the poor get access to things that would make their lives better. And I would argue that this worked out very well for America for 200 years, from 1776 to 1976, because the other assumption was that if you assiduously and relentlessly pursued greater and greater efficiency, the productivity in the economy would rise, and you would have, over time, this phenomenon happening, right? So that curve would keep moving to higher and higher incomes, with higher incomes to the right here. So that middle class family, the family that's right at the median of this bell curve, would experience growth in its income. The poor would get absolutely less poor over time. And hopefully with the mobility that this move creates, they had an opportunity to move into higher income brackets. The rich, of course, would get richer over time as well, but not disproportionately so. And now, while nobody would argue that the economic outcomes in the US economy were perfectly bell-shaped, this was more true than not up till 1976. And the rightward motion was substantial indeed. Right? So in the years leading up to 1776, as long as we actually measured median family income, it increased at about 2.4% per year real. Now, what does that mean? That means a real doubling of the median family income in a generation, in 30 years. So this was a system that largely worked well, where the efficiency that was promoted essentially by the works and thinking of these four great scholars actually worked more for the good than not. And so you could have said at the Americans Bicentenary, we're getting this working better and better. This system works, and we kept on pursuing ever greater amounts of efficiency. But then something very strange and largely unexpected happened. I don't think there was anybody who would say they were sure this was going to happen. And what happened is, starting in the mid-70s, and if you just focus on that top line, which is the top 0.01% of US in terms of income, it's the most distinctive there, but the same thing happens with the others. You can see in the mid-70s, after being quite stagnant for quite a long period, for half a century, in large part, it's taken off in a way that is far in excess, because these are real dollars, far, far in excess of anything that's happened before in the US economy ever. And the same thing holds for the top 0.1% and the top 1%. Meanwhile, the bottom 90% has stagnated quite dramatically. So something happened, and that's what I studied with Mariana and others at the Martin Prosperity Institute. What changed circa 1976 that has caused this kind of situation? And what kind of distribution is this producing? Are we producing this kind of normal distribution, Gaussian distribution of outcomes, economic outcomes in the economy? And the answer, unfortunately, is no. We are migrating to a different kind of distribution. right? We're migrating to this distribution where the middle class is kind of slowly but surely shrinking. It's not gone away, but it's slowly but surely shrinking. And this distribution is broadening dramatically in terms of the outcome, with the main difference being a huge increase in the length of the tail to the right, so that high economic outcomes are dramatically increasing. Now, this curve can be attributed to yet another gentleman from the past, and that would be Wilfredo Pareto, who in the late 1800s, he was an Italian sociologist, economist, who noted that 20% of Italian families owned 80% of the land, and 80% of Italian families own 20% of the land. That's why the distribution that's named after him is also called the 80-20 rule. In Pareto distributions, they have this very different function and outcome than a Gaussian or normal distribution, right? One, the dispersion is much greater. There isn't a big bulge in the middle, and most of the outcomes are on the left-hand side. So if you just think about families on the vertical axis and income level on the horizontal one, what this says is that most of the families are in that lower end, and a very small number of families are on the high end, but they are way far out on the high end. So what caused this? Well, it turns out that complexity kind of scholars have studied this kind of phenomenon, and the key is that in distributions that are Gaussian at their origins, but have greater and greater levels of pressure applied to them, and have a lowering cost of connection between the elements in the distribution, you can turn a Gaussian distribution towards a Pareto distribution. So what does that have to do with efficiency? Well, what it has to do is efficiency, right? Ever more efficiency puts ever more pressure on the economic system in question and can turn it to a Pareto distribution. And I would argue is turning it to a Pareto distribution. And in a Pareto distribution, effects become the cause of still more of the effect. Right? And that's what lengthens this out, and they become unstable. And the problem for democratic capitalism, in my view, is in a Pareto distribution, you do not have over 50% of the folks in the distribution seeing it as a worthy thing to pursue. And that's what worries me. When you have that big bulge in the middle, the median family, and the median family getting better every year, the median family, which is the swing voter, says, I like this system. If that goes away, you have fewer and fewer people in a democracy saying, I like the system. And I think that's why, and we'll discuss this further, I'm sure, have a lot of the turmoil we currently have in the political system, because the average citizen, the median citizen, is no longer saying this really works well for me. And what do we need to do is balance efficiency and resilience, right? So rather than pursue efficiency and nothing else, it's to balance efficiency and resilience. What does that mean? It means balancing the pressure, the constant pressure for more and more efficiency, wiping out waste, taking it to zero, with productive friction that gets in the way of pressure. We have to balance the desire to get to perfect solutions with the desire to get improvement. Because if we think we can have a perfectly efficient system and strive for that, we'll push it more to a Pareto system. And we've got to balance the connectedness that we are having in the economy, because remember, the ease of connection drives you towards Pareto distributions with productive separation. We have to balance those things. So what I think we have to do to protect the future of democratic capitalism is seek this balance rather than obsessively pursue efficiency over the edge. So thank you for that, and I look forward to the conversation, and I will stop sharing my screen.
Great. Thank you so much, Roger. And I have so many questions for you, but I'm going to hold off because I want to first bring in Keston. Keston, your work, as I already mentioned in the introduction, has looked at how issues around industrial development, industrial dynamics, industrial policy evolves depending also on regional contexts. And these issues around inequality that Roger is talking about are not independent of that, right? Of how business is organized, how policy affects how businesses do what they do, how they create value. So if you can illuminate us a bit of how you think the issues that Roger's raised relate or not to the developing countries that you've looked at, and also how I know that your work has also looked at educators, citizens, and civil society and their role, of course, in capitalism. So if you can also bring that perspective to the table. Over to you.
Sure. Thank you, Mariana. And thank you, Roger, for that, I think, very illuminating presentation. It was really nice. Thank you for your team as well for inviting me. This is really good to share some ideas and thoughts with you. I think some of the issues that Roger raises in this particular book is extremely timely and critical to understand some of the pressing concerns we have, not only in the US economy, but also at a global level. So issues of inequality, issues of sustainability, levels of desperation to some degree by many people, many working people, especially in the current economic paradigm and system that we live in. I think the diagnosis of the problem is quite astute. I think it offers a route for us to arrive at some critical answers. But I think there are also some very interesting questions that are raised as a result of the concern and around efficiency as a machine, and also the idea of democratic capitalism and what that has meant. I think I want to raise two consequences at a global level, considering some of the analyses that Roger puts in his book with respect to emerging economies and countries in the global south. So for instance, the US is one of the most important economies in the world, and I think no one could deny that. And part of this has to do with its extensive role in other economies. So much of the levels of extractive value that you would mention, Mariana, from other economies in the world happens through the role of multinationals and multinational corporations, in addition to international trade agreements and other forms of financial exchange that happens in countries of the global south. And it raises a number of concerns with respect to how efficiency through trade arrangements, but also through global value chains and the extraction of value by US corporations from these global value chains, from which countries in Latin America, we can talk about countries in Asia and so on, that happens through US corporations and what happens at the level of the world economy. So the US economy, in that sense, is not a domestic economy, it's a globalized economy. And I think we can think about it based on Roger's analysis in extending that idea of efficiency as machine to understanding some of the perturbations and effects at a global level, especially around inequality. So we saw in Latin America recently, the Chilean people and Chilean, the poorest in their society started raising hell, as it were, because of the issues around inequality, issues of being able to meet their needs, public transport, and so on. And so we can link that to that efficiency machine that the US capitalism has generated at a domestic level, but also internationally. And finally, I think we can think about how finance plays in all of this. And I think, Mariana, you're going to talk a lot more about that. But the US as the reserve currency of the many Latin American nations in particular, Ecuador has a dollarized system. So there is some transmission that's happening through the financial system to other economies in the world. I think that I have a couple sort of two questions for Roger. So around, you mentioned the economy as a democratic capitalist system, and I was wondering how that might work. How do you foresee this changing, this model changing or being realized around issues like healthcare? Because I often, when I lived in the US, healthcare seemed to be a market where efficiency seemed to be out of sync with the ability to provide actual healthcare to people, especially those most in need. So I wanted to pick your brain about how do you think that might work in terms of sort of reviving democratic capitalism? And second, around the issue of inequality in terms of the opportunity cost of also investing in machinery such as the military and the military system. I was wondering, so for many people in the US, the military has become a source of addressing poverty. So men enter the military in order to either receive an education, higher education, and so on. I was wondering, how does the investment in military have an opportunity cost for addressing other issues, other public services, social services, and so on? Thank you.
Thank you, Keston. Wow, really, really good set of questions. Quite provocative too, because I think you're also suggesting that in some cases we need more efficiency. There's lots of money actually being wasted in a healthcare system where we're putting a lot of money in, and yet the people that are supposed to be benefiting from it aren't actually getting the, the services, the goods and the services that they should be getting for their own well-being. And so could it be actually that the problems are also how we're measuring efficiency rather than efficiency itself? So John, I'd love to bring you in now. You have yourself won great awards and have been writing about issues around how do we actually build a more resilient economy? What does it mean for business practices? And so do you think that Roger's work, are you convinced by the point that we should kind of abandon measures of economic efficiency or rethink those same measures in order to build a more resilient economy? And specifically, given your work and the kind of clients that you have in the business community, what exactly do you think business executives should be doing to better balance efficiency with resilience? And if the economy is a complex adaptive system and not a machine, how do we manage it? How do we govern it?
Thank you, Mariana. And Roger, immense thanks to you. I wish you'd been my professor. In fact, I would love you both to have been my professors back in the day. I gave up economics in 1968 because it seemed to have nothing to do with what was going on in the wider world. And now it's beginning to, and now it's really beginning to come alive. And I just wanted to compliment you on your presentation, because you are dealing with immensely complex issues, which we're all going to have to wrestle with. And I think one of the audiences you're aiming for in the book is citizens. And that's normal people. And I think what you've done is to distill down into what look quite simple presentations of the data. And I have to say they're clear, but they're also incredibly shocking when you actually see the data and the trends presented in that way. My heart almost stops, because every day we're seeing in the media in different ways evidence coming through that the millennials, for example, are no longer remotely confident about or interested in particularly democracy and capitalism. And so there's an acid eating away at the world which we've severally grown up with. And I look at people now talking about the V-shaped or U-shaped or W-shaped or K-shaped or whatever it is recovery. And part of my brain thinks, good luck. I mean, you'll have elements of that, but I think we're going into a period where one system, which again, we've all grown up in, gives way to another. And that's not an automatic, and it's not a painless process when it starts to happen. And one of the questions, Keston asked a couple of really great questions. A couple I'd love to ask. One is, I've been following your thinking in this space on efficiency versus resilience. And my understanding is you're not saying let's abandon measures of efficiency. These things have to be held in tension, but they've got to be held in tension in a rather different way than we've been doing it for the last 50 years or so. So when you've presented this in boardrooms and in C-suites and in sort of investment forums and so on, what sort of shift are you now seeing? Because I think there is a generational shift happening. I think younger people are coming up who do think differently. And it's not impossible for baby boomers like myself to change the way we think. But I'd love to know what sort of dynamics you're seeing. And in some ways, I think there is a limit to how far we can take people who've spent 50 years in the system and repurpose them. I'd love to believe it was possible, but until we get a drug that does that, or an absolutely brilliant business executive coaching process that does that, I'm not counting on it. So the question is, how do we mobilize? Well, firstly, what sort of reactions are you finding in those sort of top team environments? And secondly, do you see a generational difference in how people are coming at all this? And then I think the COVID-19 experience has, in a way, I mean, you've been talking about this for a very long time, and yet now it's very clear to pretty much everyone that our systems, the systems that we depend on, economic, social, environmental, political, governance, all the rest of it, are much more fragile than we had imagined. And they are linked in their fragility. So you think wildlife trafficking and people digging up black guano in caves in China, and then hospitals not working quite as well as they should, and then sort of subway and airline systems and so on. We're living in an extraordinary world. In many ways, it's very exciting, but it's also deadly dangerous. And so you've had this huge boost for your thinking. And I suppose my question there would be, and where do you think this is going to take to us? I happen to be an optimist. I happen to think we need crises in order to really whack us around the sides of our head and get our brains working in new ways. But on the other hand, we've seen the populist wave around the world, and crises can actually get people going back into their fear zones and getting whipped up and angry. And so I'm not asking for predictions, but your sense of how this might play through would be very welcome. But again, thank you immensely. You've made my brain whir in some very different ways. So Mariana, back to you.
Thanks, John. Really, really interesting set of comments. And absolutely the question of, what are you actually then hearing in the business community? Because both of you actually are constantly talking to different types of businesses and hear both the positive, optimistic stories, but also those where there's inertia. I'm going to add in a question, Roger, but feel free not to answer it right away because you've got, you have the other two sets of questions. I'm happy to come back in and ask it again. But great presentation. One of the issues I have is, again, coming back to this issue of there's different ways of doing things. There's a very specific way of doing things, which is the maximization of shareholder value, which has led to a lot of extraction out of the economy. I kind of focus on that in my book on value, but specifically, this is a result of financialized practices. So, $4 trillion have been spent in the last decade on share buybacks. And I wouldn't advocate completely getting rid of share buybacks, but $4 trillion, that's a hell of a lot. And often when you talk to companies that do that, thinking of Pfizer, Exxon, the answer is, there's no opportunities. It was, we have to give the money back. So that's a decision, and it's a different decision from those from companies that aren't doing that. And some of the companies that aren't, excessively buying back shares and that do have more of a stakeholder value form of corporate governance are actually in countries that I would argue are quite efficient. Think of South Korea, think of Germany, where you actually have efficiency and a efficiency and a more balanced income distribution. And so I'm just wondering if you can reflect a bit on that, even without going to developing countries. You have, what's your answer to the kind of the difference between Germany and the US?
Sure. Sure. Well, thanks for all the questions, and I'll just try and walk down them before we talk about others. Keston, on healthcare, I am a bit of a proponent of the Canadian system for what it's worth, which most people do outside Canada don't realize it's relatively unique. It is mainly privately delivered, but government funded. So what I think you get are not so many of the grotesque inefficiencies of the U.S. system. For any Canadian living in the U.S. system, it's for healthcare, it's just like mind-bogglingly inefficient. And the Canadian system is pretty efficient. Is it perfect? No, it's not. But it's not. People think it's government-run healthcare. It's actually not. It's government-funded healthcare. So the government, and it's provincial, the governments are big HMOs, if you will, but everybody's in the HMO, so there aren't all these selection bias, moral hazard problems, and it is delivered by private individuals, private doctors, etc., delivering it. And I think it's a model for the balance of resilience and efficiency in my view. And it's always amazing to me, that Americans generally say, well, we don't want to be like Canada, where somebody determines who your doctor will be, and no, that's actually kind of not the system at all. And on military, I think you point out something that I think is a wonderful thing about the U.S. military, and that is the degree to which it's an advancement opportunity for less economically advantaged folks in the economy. And so I think the military actually does a great job, and I really admire the corporations that have programs designed to hire people coming out of the military, which is great. But you also alluded, and I would just basically confirm what you said. You alluded to the dark side, which is that it sucks up a lot of economic space, and I would wish for a more peaceful world where everybody can tamp down how much they spend on the military. And of course, the U.S. spends the greatest amount, and has an important kind of role in doing that. But all things being considered, I wish the U.S. military continued to be this great way for people who didn't come from advantage to get ahead, but it was a little smaller. And John, on your question of the generational shift, yes, I mean, I see, I think very much what you see, and to me, it is fully unsurprising, right? We're talking 1976, right? So anybody under 44 has experienced, unless they happen to be an offspring of somebody in the top kind of 1%, or they are a member of the 1% themselves, will have experienced 44 years of, relatively speaking, economic stagnation. So I'm just like unsurprised that they feel like maybe this isn't an awesome system. This isn't a system. This capitalist stuff isn't a system that we absolutely have to be behind 100%. Like why would they think that? Now, people like you and me, John, we're old enough that we lived for a decent amount of time in the system before then, when that middle income family moved smartly ahead and saw this really productive future. And so I think we are more inclined to think that this is an anomaly, that it'll come back, and in part, I'm afraid it isn't going to come back on its own. In fact, my argument would be that if we don't change a few of the fundamental models of the way we manage and run the economy, it'll get worse on this front, not better. We'll continue to have reasonably strong economic growth. America's had reasonably strong economic growth since 1976. but it just goes to fewer and fewer pockets in a more concentrated way, which is just about the last thing that America stood for upon inception and for the first couple hundred years. And in terms of crises, it's really interesting, John. I probably have changed my mind a little bit on crises after the global financial crisis. Because as you know, John, I work with lots and lots of corporations, so I see this more up close and personal than not. And I think it scared the living daylights out of the corporate sector to such an extent that it pulled in its horns and didn't get back to investing and being optimistic and growing. And so like rather than being a wake up call, it was a sort of a, get protected kind of effect. So it'll be interesting to see. And like my fondest hope for the COVID crisis is at least that 1 million people didn't die completely in vain. That we'll have some good things coming out of it that will make it better for the rest of the world that managed to get through it. But something will have to be different than it was coming out of the global financial crisis from my perspective. And Mariana, I mean, you're preaching, of course, as you well know, to the converted on the whole shareholder value thing. One of the most kind of clicked on articles that Forbes has ever put online is shareholder value is the dumbest idea in the world that Steve Denning did in a interview with me. It is interesting, though, to me, Mariana. It is consistent with the themes of the book. So, for those of you who have read the book is a lot about models and how models, we adopt a model because we have to model the world. We have to figure out how to deal with this complex world, and we model the world, and then the model becomes the thing, right? It becomes reality. We don't think, oh, this is our model. We should be making sure that our model is right. It's no, that's the world. And really, what started in 1970 with the famous Milton Friedman Business of Business is Business article, people think of that as an article that was about how corporations should leave it to other people to make the world a better place, because that was the core theme of it. But it snuck in the start of a model that I think has been more transformative than people really realize, which is that as a corporation, you should have a single unitary objective function, right? Because that's a subtext of that article. If you go back and read that article carefully, that's what it says. And then Mike Jensen, who's a great guy, he's actually a friend, he's a great guy, and he probably regrets this now, really doubled down on that in a number of his writings, where he made that a very explicit argument, which is, if you're a corporation and you have a whole bunch of different kind of goals and not one defining objective function, you're just not going to be able to make decisions. You'll be all confused. You won't be able to be effective at all. And I don't think people really understand how much that argument won the day. Not mainly, not almost entirely, completely and utterly. So it became the standard, which is, you must optimize one thing or life as we know it on the planet will end, cats and dogs will sleep together, and it'll be a total disaster. And so, Mariana, my view is that the shareholder value maximization thing is actually only sort of a part of the problem. Right? It's just a manifestation. It's, since there has to be one thing, and don't shareholders own the company, I guess it should be that thing. But the great Satan in this is the one thing. And then I asked the question, okay, so one of the ways I kind of judge models is does this model work more like human beings or not? Because if the model works unlike human beings work in some fundamental sense, it's really artificial and probably unsustainable. So I ask anybody, like Mariana, do you have a single objective function for your life? You're trying to maximize one thing.
Survival for my 4 teenagers.
Maybe survival, but even that, survival and happiness, right?
No, I'm kidding. Mm-hmm.
Yeah. So the answer is no. You're trying to do things, and I remember, in the good old days when I was running a consulting firm, people would say, "Well, I have this difficulty balancing work life and home life," and so human beings spend their entire life balancing multiple objectives. If that's true, and corporations operate in that world, what on earth is it that makes us think that somehow that would be a sustainable model, right? That good things would flow, it would be natural. And the answer is nothing. So this is in some sense one of my key goals, and it's one of the recommendations in the book is we have to absolutely defeat. It's not that I want that I'll leave it to other people to decide what other functions they want, employees, customers. I have my views on that, but we've got to get away from this unreal, unsustainable notion that one objective function can be maximized and good things will happen.
But behind, so what I love about your book is especially the part 2, the solutions. So you have, an agenda for business executives, political leaders, educators, and citizens, right? Yeah. So it'd be interesting to bring that part 2 also to part 1, which is because otherwise we don't disrupt actually the underlying model of value creation, which you're also saying needs to change, but that in part 1 potentially still sticks to the Michael Jensen idea of business. I mean, what actually underlies that one number that you're absolutely right, we need a much wider dashboard of Michael Jensen's theory is a theory of value, right? A theory of where risk-taking actually occurs. The whole, maximization of shareholder value assumes that shareholders are what's called the residual claimants, right? Everyone else has a guaranteed rate of return, and then the residual is what the shareholders get. So if there's no residual, they've just risked a lot, right? So, but that's false, right? I mean, Warren Buffett always says, my wealth was actually a result of a massive social infrastructure around me. So if we open up the concept of citizens and the educators that you talk about in part 2 as value creators, in some ways risk takers, that requires investment, reimagination, dreaming a better future. That means that
it's a complex adaptive system, right? I mean, it just is. It
means it's not just about that there's one number. It means that it's all premised on a completely false narrative and theory and framing of where value comes from in the first place, and bringing citizens and that collective spirit to the fore, which you do so well in part 2.
Yeah, I mean, again, the people are surprised. Like, again, people, if you're as close to the corporate world as I am, there would be absolutely no surprise about the share buybacks. I mean, it's just plain and simple. It turns out that the data show that in terms of share price effect, dividends have a tiny, if not negative one, and share buybacks have a positive one. So it's like simple as that. If you're maximizing that one thing, which is the share price on the day my options vest, then it's a no-brainer. And so we just got, I mean, this all goes back to the notion. I mean, I'm radical on this, although sort of nobody's managed to come up with an argument for me. They say, no, we couldn't do that. But I'm against stock-based compensation. Full stop, right? And Mariana, you asked these governance questions. Why aren't boards governing better? Well, I mean, let's go back to the fundamentals. This is why I want people to go back to the fundamentals. So there's notionally a principal agent problem where the managers won't act in the best interest of the shareholders. And so we have to have a board of directors that ensures that they do. Who are the board of directors? Another group of agents. Why would those agents operate any different than the agents they're supposed to manage? Answer, no reason. So somehow the idea that they will be the savior, it's just not. As long as they're in a context in which the world has agreed, essentially, right? It has since the mid-70s kind of had this agreement that unless you have a single unifying objective function, you can't operate. Yeah. That's what we've got to demolish. Full stop. And until that is demolished, all the other things that we'd like to have happen aren't going to happen. We're not going to get better governance. We're not going to get managers thinking about who all creates value and how to distribute it. We just aren't.
So thank you for that. I want to bring Keston and John back in quickly in case you guys wanted to add anything from the responses from Roger, but there's a whole list of wonderful questions from the Q&A that I also want to pose to you, Roger. So Keston and John, did you want to say something before I go to the Q&A to react to? Maybe
not
start with
from
Keston.
my end.
No? Okay, John?
Yes, just to add another question to the steaming heap, Roger. You mentioned Milton Friedman. One of his quotations that always rattles around my brain is that thing about the federal government. So in the US, if you put it in charge of the Sahara, we'd run out of sand within 5 years. Everyone now is saying we need government back, we need more government, and so on. So my question is, in the book, when you're talking about political leaders and the agenda there, you say it's time to fight the giants. Well, we start to see that, but is there a problem too of giantism in the public sector, in government as well? And if so, how do we fight that one?
No, it's a tricky one, and I guess I would not be for giant government. I guess I'm for government that has a different fundamental approach, and that is an approach of constant tweaking, prototyping things, tweak, rather than giant bold moves. I'm now to the point where I mean I've seen enough giant bold moves by governments, non-governments alike. It's a complex adaptive system. When you pull a big lever in a complex adaptive systems, chances are as good that you're going to burn whatever you want to save down as save it. So what I think we need, and government would not be viewed as sort of as bureaucratic and slow moving, if instead of saying, the electorate has said there's a problem and we now have the fix, right? There's a law firm in New York that keeps a running total of what percentage of Dodd-Frank has actually been enacted, like the regulations behind Dodd-Frank. And last time I checked, and so that was maybe 8 or 9 years in, was like 40%. So the legislation that's going to save the capital markets from another meltdown is taking 20 years to write the enabling regulations. That just isn't going to work, having these grand master strokes where we can fix everything. Instead, as I say in the book, we should put a required review on every new piece of legislation that recognizes the truth about it, which is it's going to be found wanting in some way. It's going to be gamed in some way. And so we should automatically recognize that we need to revise and renew it. If we had governments doing that, we'd have a better system. I mean, what's a nice effective industry? Software. Like, what is the most notable about the software industry compared to all other industries that I'm aware of? It publishes junk, right? It goes out to beta customers and said, this is glitchy code. This is buggy code, but you want to be one of the first users. So it's going to be full of bugs. Just tell us what the bugs are and we'll fix them. And then they fix them. And then what do? They fix them some more and some more and some more. And that's what we call 1.0, 2.0, 3.0, 4.0. It's a great system. And how do they possibly get away with that? It's not by overpromising, right? So the government said after the dot-com meltdown, You know, we're Sarbanes-Oxley. It's going to fix this. We're going to have more transparency, and we're not going to have these kind of big capital markets blowouts, right? How many years was it between the enactment of Sarbanes-Oxley and the global financial crisis? 6 years, six and a half years. I mean, that's what happens when you say, I have a giant lever that I am going to pull and everything will be fine. Just, we got to get away from that. And we have to stop having citizens ask for that, right? Citizens can't be kind of nanny state-ish and say, oh, pull all the levers for me. They have to say, I know that's tough. You know, here's what we want to accomplish. Start down that path towards making it better, and keep on tweaking, and don't be lazy.
Yeah. What you've just said actually goes to the heart of a lot of what IIPP does when we talk about practice-based theorizing. So if we think there's a better way, say, to design procurement policy to really kind of crowd in bottom-up solutions towards climate-related goals, you need to experiment. You need to transform it into what we call a sandbox, a policy sandbox. And in your book, you really
and recognize
so
that you're going to be wrong.
Yeah. So you say here that we need to keep in mind the whole while working with the component parts, pursue improvement, not perfection, and relentlessly tweak instead of attempting to find those perfect solutions. I'm actually going to start reading these amazing questions that are coming in from the audience now.
Sure.
Okay. Yeah. So I'll read 2 at a time. One is from Leonardo Burlamaco. He's actually a wonderful colleague based in Brazil, in Rio de Janeiro. And he's been writing a lot actually about this issue of financialization, but he emphasizes something that you're actually getting at when you talk about Dodd-Frank. But he says, hey, this isn't just about shareholder value, and we know all the problems that brings about, but it's also about the whole financial system actually working for itself with the blessing of financial regulation.
Yeah.
So it's not only that the financial regulation maybe isn't working, it's been supporting this problematic system. And we have colleagues in IIPP, Josh Ryan Collins, who's been writing about this too, and how something like in the UK, for example, 80% of finance ends up back in the financial sector, in finance, insurance, and real estate, fire. And that's being rewarded. Another question by Dan Wainwright, having just come from a talk by Katerina Pistor, I'm a huge fan of hers, talking about how the law codes in wealth and inequality. So, how the law codes in wealth and inequality. To what extent are the drivers towards efficiency coded into the law, for example, in duties to shareholders and other, versus being about individuals and mindsets? What are the legal reforms that you think, Roger, would enable a more resilient and focused system?
Perfect. Well, so I can't say much to your Brazilian colleague other than, yep, he's absolutely, he is absolutely, yeah, is absolutely right, and I think in part the absolutely crazy quilt of financial regulations in the U.S. actually are an enabler of this. And as you know from reading the book, Mariana, I talk about the Canadian system, which is much more of a kind of a collaborative system of oversight where the response of the financial sector is, if you don't like it, sue me, is not, if you don't like it, sue me. It's okay. Yeah, maybe that's not such a great idea. And it's a more sort of flexible system. And you may say, oh, flexible, that means the financial institutions can get away with anything they want. Well, basically not, right? They I think are made to understand that there will be principles applied and they will be applied flexibly. And so I think we need more of that. But I also think that I understand how the bailout of the financial system had a rationale in after the global financial crisis in the U.S. But I just wouldn't have made it such an attractive shareholder proposition, right? I would have, and in the UK, actually, it was less of an attractive proposition for shareholders. They got wiped out to a greater extent than they did in the US. They got made something damn close to whole with great upside in the US, and that just contributes to this notion of the sort of financialization. They're too big to fail, and we have to bail them out, right? You know, private benefit and a public cost. So I do think we have to be tougher next time on that, and there is going to be a next time, because they're back to doing the same things they were now. The amount of funding for kind of M&A and in private equity is just back to the same level. My friends in private equity, the sensible ones in private equity, are saying, did we learn nothing at all? You know, you can go and buy a company that's sold by the investment bankers who put a 7-8 times what's called staple on it, which is whatever equity you put up, we will put up 8 times that much debt, right? That was what was happening before the global financial crisis. I like Dan's point too about and I will borrow with attribution his thing, law coding in. I like that. I mean, I think that is right. I think some of these things get coded in. I haven't kind of studied that myself, but
it's a book, by the way, by Caterina Pistor, called The Code of Capital. Definitely recommend it. Yeah, he's just heard her speak. Yeah, it's fantastic. Yeah.
But oh dear, what's their name?
Oh, sorry.
Lynn. Oh God, the recently deceased legal scholar in the U.S., Lynn, and I know I'm forgetting her name, Payne, I think, wrote about how one kind of rogue judgment can get misinterpreted and used to even simulate code, right? The Revlon case looms large in the US, but if you read it, it was incredibly narrow in its application, but it's viewed as, no, you're going to get sued successfully by shareholders if you don't do the thing that maximizes short-term shareholder value. And it doesn't say that. But so it even goes broader than sort of coding to sort of, kind of implied code almost. So I think that is a problem.
Okay, next to, and by the way, John and Keston, feel free to just come in. I'm not going to call on you guys, but feel free just to unmute and come in with any of these questions. So 2 more, one by Sanya Terlovich, I hope I pronounced that okay. High efficiency and low resilience. Does that explain the arguably poor response to the pandemic by rich Anglophone countries?
Yeah,
personally, I think Deloitte doing our testing and failing wasn't exactly high efficient. Anyway, sorry, go on.
No, but
sorry, let me just ask the second one so we do 2 at a time.
Oh,
otherwise,
yes,
is that
sorry.
Okay? That's one. Yep. That's Sanya. Second one by Greg Watson. Do you think environmental, social, and corporate governance data and impact investing can help fix the hegemony of simple valuation models? Does there need to be more theoretical critique of capital asset pricing models to allow impact investing to flourish?
Yes. Okay. So Sanya first. Yes, there's all sorts of stuff coming out. I saw a nice study about hospital systems in Arizona on just how much obsessive efficiency went on that made the response to COVID so much harder. So trimming nursing staff down to the absolute bare minimum, so that when the crisis hit, you had fired all the quote excess nurses that were no longer excess. Same on buying PPE. So absolutely, COVID preparation or just whatever the actions of hospitals in the U.S. in the years leading up to COVID was all efficiency driven, so that we took out all the slack, and all that slack was what was going to keep a bunch of people alive. And so I think COVID is a big lesson in no resilience and high efficiency. For Greg, yeah, my view on this is I am optimistic, and guys like John Elkington are part of my view of optimism, which is I have a very strong view that even if a person wants to do something, if they don't have a tool for doing it, they just don't do it, right? So before the Black-Scholes option pricing theorem, there wasn't much trading of options because traders didn't know what they were worth and didn't have a tool for figuring out what they were worth. Before Google, Google's business model, people didn't do much online advertising because they had no idea whether it did them any good or not, right? But after the Black-Scholes option pricing theorem came along, people just said, oh, I can plug these 4 variables into my equation, figure out what this option is worth and get trading. After Google told you, we can tell you how many clicks you got for the ad that you placed, boom, people started using it. So people needed a tool. People were not going to invest in sustainability or sustainable companies until we had the kinds of kind of measurement systems that John was part of either creating or supporting or the like. And now we have them. And guess what? We have all sorts of funds that say, well, unless you're Sustainalytics, double B plus, you're off our screen. And so lots of people say, oh, good, I can now do it. We didn't have a tool to do that before. So what happened? People didn't do it. You weren't going to go to your investment advisor and say, I would like to put 1/10 of my savings in a sustainable fund if the investment manager said, well, I don't know how to do that, right? But now the investment manager says, oh, well, we have all of these sustainable funds and here are the criteria that they use to be sustainable. So I'm optimistic that with more and more tools, we will have more and more behavior, because in the end, I think people are not, callous, people are not stupid, but if they don't have a tool, they ain't going to do it, even if they'd like to. And we have many more tools, and I'm encouraging the building of more tools. Your colleague and mine as a fellow, Zeynep Tan. Love her from MIT, Good Job Strategy. Love Good Jobs Institute that CCO, because it gives companies who say, oh, we do want to be fairer and better to workers in an effective way. Well, you can go to the Good Jobs Institute and they will for free, right? Or at very low cost, give you a set of tools that enable you to do that. So I'm optimistic on tool development in all the areas that the questioner Greg was talking about.
Great, thanks, Roger. John, since Roger also just mentioned you in his response, there's a question here by Ian Grant who says, what happened to the triple bottom line idea? Was it lost in greed? And weren't you, this is me now asking you, didn't you invent that concept of the triple bottom line?
I did, yeah, sort of over 25 years ago. But then I did a product recall a couple of years ago through the Harvard Business Review. They said that was the first time any management concept had been recalled, but I still think it has value. I think the problem is it's been applied in a responsibility framework. So we've tried to be nicer and better as companies rather than thinking about the system of which we're part. And now we've got the resilience problem that the systems are coming apart. And so I think the only way forward is regeneration. We've got to invest in all of the systems, economic, social, environmental, political, governance, that we are dependent on. And we got out of the habit of investing in systems. I think that's very much part of what Roger's book is saying to us.
Yeah, the reduction, the damage that reductionism has done to the modern economy and modern society is almost incalculable, right? It's not obeying is this how human beings work, right? The answer is how your lungs work, separate from how your heart works, separate from how your liver works. No, right? So why would it be a good thing to separate those disciplines out completely and utterly, so you don't have to know anything about the other thing to operate on the other? It can't be justified, but we do that writ large across the entire economy.
Okay, a question from Zakir Tamiz. How do we restructure incentive systems in a concrete way? Give us concrete examples to ensure more long-term thinking by investors, both at the firm level and at the policy level. And then there was a question that kind of went back to some first principles in your book. Can you just clarify, Roger, the connection exactly that you think exists between striving for greater efficiency and increasing income inequality?
Sure.
Are they necessarily linked?
Yes and no, they're not linked linearly. What they're linked is if you keep pushing efficiency so hard that you create such a level of pressure on the economic system in question, it will turn Pareto. And when you've turned Pareto, you get ever increasing amounts of inequality. So the question is, how far can you push a system until it turns Pareto? And what makes it turn Pareto is when effects overwhelmingly become the cause of more of that effect, right? So Instagram followership is Pareto distributed, right? The median person on Instagram is between 100 and 150 followers. Last time I checked, and it's probably way more than this now, Cristiano Ronaldo was #1 at 216 million. So 1 million times the median. Why? It's because in that super highly competitive world, when you go to the Instagram, one, you can compare everybody. So the cost of connection is down to 0. And fame in soccer or football, this is football. And fame
calcio.
Yes, is connected to everything. Everything is connected to everything, and it's a brutally competitive game of fame. Unless you have fame, right? And many Instagram followers, when somebody decides whether to follow you or not and looks how many followers do you have, you won't have many and they won't follow you, or if you have many, they will follow you. So the effect, followers, becomes the cause of more of the effect. That comes to place in highly efficient and tightly coupled markets. And the consequence is income inequality. As one of the many consequences. One consequence is how many Instagram followers you have. But if you have as many Instagram followers as they, I mean, Kylie Jenner gets paid $1 million per tweet, per sponsored tweet. $1 million per sponsored tweet. It's a different world than 40 years ago when it would take Frank Sinatra 100 concerts or more to earn that. She can do it with a tweet. That's because we've got a Pareto system. So that's the link. But more efficiency is not always bad. It's when you push it to the extreme, as if more is always better. Incentives. The number one key is to just stop believing that monetary incentive compensation is actually helpful. Okay, so this is a astounding thing. You'd have thought, like, if we just add up the time last year spent by the people on this Zoom call and participants, how much time they spent either designing a monetary incentive compensation system, monitoring one, negotiating one, talking about the results of one, it would be a scandalously high amount. If I also told you this, that there is no rigorous academic study that's ever been done that links incentive compensation structure to monetary incentive compensation level, if you will, to entity performance. It's not amazing.
If I may, could I wanted actually to go back to the point about tools, and I was wondering to what extent or how do you see the taxation system working under, I guess, a new system, right? Because, I mean, recently we've been seeing the IRS. I was looking at a report, I think, where the number of people who have been assigned to address those are the top tier incomes, people who enforcers at the IRS, they have reduced those numbers of enforcers who were going after top tier income earners, and they've increased the enforcers for people who are middle income or low income groups. I was wondering to what extent, so that speaks to the issue around efficiency as well. they're supposing that efficiency, reducing the number of people who work at the IRS at certain levels or certain levels of functionality would help, calibrate the tax system in such a way. What's your thought on that?
It sounds like a bad idea to me. Yeah, that I hadn't read that. You'll have to send me a link because yeah, I mean, there's all this sort of false efficiency, right? Which is, and often like cutting wages, cutting headcount is false efficiency. It by the measure you use, we've lowered our staffing, so we're more efficient. But then customers disappear, and so your staffing cost as a percentage of sales actually goes up because your sales went down so dramatically. So what you described to me sounds like kind of false efficiency, where somebody had some proxy that said, for, you're in charge of, income taxes for incomes of people above whatever, 100,000 or 500,000 or something, make that more efficient. And that person says, yes, sir, yes, ma'am, and cuts 10% of headcount and says, there, I did it, I'm more efficient. But that's not taking a system dynamic look at it. And that's what I see with reductionism. Reductionism says it would be totally fine for the supervisor to say, we have three different, kind of businesses. One is income tax for people who make less than 50,000, people who make between 50,000 and 500,000 and 500,000 over, and you go separately to each one of them and say, be more efficient. And you end up, with something crazy like what you described. Sounds crazy to me. I believe you absolutely, but it sounds sort of crazy.
There's one question here from David Freeman, who's one of our PhD students, that I thought actually, Keston, you could also come in on this because it has to do again with development, different development models. And the question is, do we actually have also the problem that some international, multinational, multilateral organizations like the IMF and the World Bank have actually been pushing some of these governance models in the wrong direction?
Absolutely. The IMF basically, I mean, I'm not a big fan of the Washington Consensus, about which the IMF is a piece, which is kind of selling kind of efficiency to all these poor countries, to say, unless you're efficient the way we deem efficiency to be measured and monitored, you ain't getting the help that you need. So yeah, I'm not a fan at all.
Keston, did you want to say anything about this? Because I know you study this.
I mean, so I've written a little bit about this with respect to the climate crisis and climate policies and how the role the IMF has played in that. And I mean, the government's model of the IMF and the World Bank are outdated. I think many people who have studied these organizations know this. I think Robert Wade had written a report about the kind of thinking at the IMF has devolved into one-way set of thinking. Even though there is some diversity in their research department, their operations department tends to operate very differently on the ground level. And so the diversity of thinking, the governance model of the IMF is really, it's past sell date really at this point.
Yeah. I mean, it's one of these things that where I just think, IMF, World Bank have not exposed themselves to constant tweaking of their models, and then they get stuck getting ever more out of date. And then it's, of course, very intimidating to then say, and so now I've got to make this giant change. And that's why, tweak. That is the best way forward.
And it's interesting, if I may, the relevance of the IMF increases after a financial crisis.
Yes.
Which tells you by itself that if there's no crisis, then the IMF's ability to really do and step in. It's just, so it tells you they've just really gone past, what they can actually do to help and tweak the global economy.
Yeah.
Thanks, Keston. So I think, unfortunately, we probably have time for one more question. If there is time for another, I'll ask that too. But Roger, just because you talk so much about complex adaptive systems, I wanted to ask you this question by Neil Harrison. If the economy and the society are complex adaptive, complex adaptive systems, the excess returns to a small number of rich and well-connected as a consequence of positive feedbacks to wealth. How exactly would you propose that we reduce positive feedbacks or establish negative feedbacks which prevent them?
Yeah, well, I talk about some of them in the book. So I think the current tax regime in the U.S. has had a 35-ish year run, and it hasn't produced what it was believed that it would produce. And I would argue for going to a regime that is more redistributive. So that would deal with the positive loop that he's talking about. I also think that that some of the kind of changing the financial markets in some of the ways we've talked about, so to make things kind of more long-term oriented. Two is trading of value is become far too lucrative. Mm-hmm. Right. And so yes, the best way to get on the Forbes 400 list of richest Americans is to start a tech company. Mm-hmm. So that's good. That's hopefully creation of value. Second biggest, by far over the third biggest, is to manage other people's money and charge them 2 and 20 for creating no value kind of at all, trading stocks, being a hedge fund. And so I think we've got to make changes that say the purposes of the capital market. When we created the capital markets as they in their sort of current form in the early 20th century, the priority was issuers first. So if Mariana wanted to start a company, to build a factory, to employ people, to provide a product, that was what the capital market was for. Second, it was for me. If John Elkington and Keston Perry want to invest some of their savings, they can invest it in your company. They were second in the priority, and an afterthought were traders. Yeah, there can have to be people who trade to make liquid markets. Now it is unquestionably they're designed for traders first. Everything is designed to make it easiest for traders, hardest for issuers. That's why there are half as many public companies now as there were 20 years ago. The costs of that system are so onerous and high, and the investors are somewhere in the middle. But everybody's an afterthought other than traders.
Okay, I'm going to try to get
back to Dan and coding. We've in some sense coded that into the management and regulation of the financial system.
Great. It's interesting to think back in the day when banks actually had the names of the sectors in the real economy that they were financing, right? Chemical bank. But yes, of course, chemicals today aren't exactly something we would necessarily think is producing a regenerative economy. So also directing within the real economy, both policies, but also finance. So this comes to Jessica Weitz's question. She says, given the talk on regeneration, and all of you feel free to come in on this, she says, if you were to investigate 3 to 4 specific areas to redefine our future economy, where would you focus? And to be clear, these investigation areas would then lead us to where we actually want to go. So where should we be investing to create new directions for our economy?
I would invest big in tools, actually, for people and companies to make the kind of choices we'd like them to consider, right? So I believe in people, and if you give them tools. In Toronto, when we were living there, when the blue boxes first came, when they handed out a blue box for recycling for everybody, what did everybody do? Put stuff in it. Before that, what did they do? Put it in the one garbage can they had. I just believe totally in tools. So tools for managers to make choices that are more holistic, tools for policymakers to keep on tweaking things, tools for individuals to act in a way that's more consistent with the way it want to be. I'll just say that's would be my number one.
Great. And on that note, unfortunately, we do have to finish. I think, John, did you want to come in? Were you going to try to say something? I saw you unmuted.
I was, but let me just end probably on behalf of everyone of just thanking Roger immensely, and just to pose a question that his book sort of had me thinking about, and then try and provocatively answer it. And he talks about educators needing to train students in qualities as opposed to quantities. Does that simply mean, Roger, that we now hand over to women and you and I can go off into the deck chairs into the sunshine? I hope not.
That would not be a bad idea, but yeah, no, it is. I do worry that we're building up one arm, and the other we can't lift over our shoulders anymore. And this is the manipulation of quantities, and this is the appreciation of qualities. And actually, to be honest, you could see that through the lens of Mariana's work, right? Like I would say, Mariana, your work is all about qualities. Kind of what is the nature of the way that they're thinking about creating value, right? Yeah. I'm not saying that there aren't quantitative outcomes of that, but you take I think a sophisticated qualitative lens. We need more of that sophistication, and that to be taught, because I'd be fearful the young Mariana would be taught that stuff is not what you're going to make an academic career out of. That's not what's going to create new knowledge. It's crunch the numbers. Unfortunately, everything important can't be quantified, and everything quantified ain't important.
One of the things the Institute really believes in is that last point you made before John came in on tools. And the experimentation that your whole book advocates for. We have to experiment. We have to constantly go back and understand how to improve, as opposed to go back to these kind of uniform efficiency models. But one of the things we did recently was bring a tool to the European Commission that then actually turned into law. So we coded it, which is this concept of missions and a moonshot tool, so that policies be directed at problems, big problems, as opposed to lists of sectors, lists of types of firms like SMEs, lists of type of technologies like quantum computing. All the great things in our phones today came out of problem solving. The internet came out of trying to get the satellites to communicate, GPS similarly. So what are the big problems of our time that can actually bring together these different actors that you talk about in your book and these new governance models is a big question. Keston, I saw you unmuted as well.
No, actually, it's interesting. I was actually going to say some of your work is definitely on tools, right? All of what you're doing is building those kinds of tools. And if I could add to the last question, I think citizens groups and social groups and citizens movements are really interesting areas of considering the kind of change that are happening, not at the high level, but at a very ground level of understanding what they're trying to do to innovate, what they're trying to do to experiment, in trying to change some of the governance models in their own spheres of influence.
Yeah.
So
citizen assemblies, yeah, absolutely. Yeah. Thank you for that. Well, listen, I have nothing else to do but to thank all of you so much. Roger, especially, amazing presentation, such a good balance between graphs, figures, and enlightening qualitative comments as well. John and Keston, thank you for your really great questions, and all our audience. I think at one point we were over 200, and slowly people are going to feed their kids or to have their gin and tonics. And so thanks to everyone. We should somehow virtually serving them during these seminars. So thank you to everyone. Thank you, Roger, for being a friend, a colleague, and inspiration to so many different people and businesses, citizens, everyone around the world. So
my pleasure.
Good luck with the book.
Thank you.
Bye-bye.
Bye-bye.